Now we can actually start our webinar. Good morning, everyone, and welcome. So today is Monday, and we are speaking about agility. And thank you for joining us. My name is Elena Grinyuk, and I'm responsible for the Central Eastern Europe at the SME Banking Club, and I will be hosting today's webinar. And as every Monday, I'm glad to be joined and supported by John Mark Williams from Agile Business Consortium and Maria Tsinusa from Integrating Consulting Group. So thank you very much for joining today.
Thank you very much indeed. Nice to be here, Elena.
Thank you for inviting us, yes.
Thank you for joining. So before we start, a very quick mention on the organizational moments from my side. So our webinar is scheduled for half an hour. The format of webinar is a panel discussion, so you're welcome to type your questions right now from the start, and we will be answering them, I think, on the go. So please type your questions into the chat. And we are recording this webinar, so that after we finish, you will receive the link to the video and to the presentation. So today we decided to discuss the topic of agile in risks, as this is a crucial element of agile strategy and a constant topic of discussion on whether risks should be included in the agile teams or not. And I guess if a bank runs agile projects within agile teams, so then the risk management in agile framework should differ from the traditional one. So if so, what are the tools, techniques, and approaches to manage and monitor risks in the agile projects? And Maria and John, I'm passing the word to you as to our agile experts. So Maria, would you like to start?
Yeah, sure. I actually would like to start with making a differentiation between agile and risk, because as I mentioned to you before, once we started to think about this theme and how relevant could be for our audience, we understood that depending from the profile of the audience, actually the theme could be taken into two types, in two parts. On one side, the part that is interesting for banks is how do you fit in an agile organization, you as a risk department? And then there is the other broader theme that is about how do you manage risk in an agile project? And that risk that you need to manage, be it financial risk, credit risk, or any other type of risk, regardless of the industry you are operating. The reason we want to make this differentiation is that actually the contents might differ and the approach to it might differ. So as we are invited here by Olena, representative of the SME Banking Club, we will start with the first one, how do you fit in an agile structure as a risk department within the bank? And we would like to propose to you, starting from here, to discuss next week on how you do with the risk management in agile projects and as a more general topic. Okay, so I think one of the most important topics when it comes to one of the most simple questions when it comes to risk department in an agile structure within a bank is whether are they inside or outside the delivery team. And these two models of operating have been actually tested, and like many trials and errors have been done by the banks, because there is no true recipe in terms of how you can include risk department in a bank. And if you recall the discussion of last week and the 2 weeks before, actually, with regards to finance department, risk is also seen as one of the support functions within a bank. And most of the times it might happen that they are excluded from agile structures by default because agile is thought to be something that is more relevant within business. However, what we see these days is we see that there is more and more need for all the departments within a business to embrace the agility in order to manage the changing environment around them. And risk department is making no exception in that matter. The reason for which there is such a long discussion is that methodical risk management practices are central to the way banks work. So it might seem that it is impossible for large banks, large incumbents to reconcile this risk approach with fast and fluid techniques of agility. And this is the struggle that you would have, because the methods that the bank may have in managing risk might appear cumbersome, but they reflect the industry's heavy regulatory burden. So it is not something that we can ditch one moment to another. It's something that needs to be carefully taken into consideration when designing the organization. So whether you put the risk inside or outside an agile structure is a question, but it is of vital importance to avoid errors that might harm customers' outcomes or the very institutional stability. So this is like a more definition even than including finance team in an agile structure. Risk department is even delicate because it calls to the very structure, to the very existence of a bank. And I'm curious on what is your experience, your take on, for Olena and John as well, what have you heard so far in terms of organizing risk within agile structures in a bank?
Great, and a great exposition, I think, Maria, of the challenge of agility for risk teams in a bank. I think really, obviously, risk is as you quite rightly said, I like your terminology, method. Banks need to take a methodological approach to risk because of the requirements of the regulatory framework and the necessary compliance. And yet, agility is, by definition, the power to adapt and respond to change. And consequently, if the change in the marketplace, which addresses the bank, moves faster than the regulatory framework, the challenge for risk teams in the bank, if they're going to be part of an agile bank, is keeping up with those changes. And I think one of the I used to work for Santander, I think, as you know, and one of the things that Santander did, which was a very far-reaching move, actually, was to push very heavily this idea to everybody in the bank, that everybody in the bank is risk. Risk is not the responsibility of the risk team in a bank. It's the responsibility of every individual in the bank. And that became the philosophy in the bank. And what that means is, in those teams which were operating in an agile way, they themselves adopted responsibility for ensuring that they complied with the risk structures within the bank. And I think this challenge of how does the risk team interface with agile projects within the bank has to be embedded in the idea that everybody in that agile project understands risk from a banking perspective and thinks about that risk in everything that they do. What that might mean, of course, is that the level of agility or the pace of agility within a bank might need to be thought about very carefully before agile projects get implemented, because otherwise, of course, the time of the project is likely to extend, and that can't happen in an agile project. Time and cost are fixed. So thinking about things beforehand from a perspective of a knowledgeable, informed, agile project team that knows and understands about risk. And maybe one of the solutions to that is to a little like you suggested, Maria, in terms of finance, is to think about having a risk business partner in any agile project team. What do you think?
I really like this idea, and actually, in my experience, we work with this kind of combination, and that was very relevant for us. But I have to tell you that it took quite some time to adjust for the let's say business team to adjust and synchronize with the risk department in terms of understanding the agile practices, in terms of gaining the agile mindset, and in terms of simply put synchronization between the teams. Because it's one thing. When you start, the traditional banking goes like this. You have risk department in a sort of ivory tower. They are telling people what to do, yes. Yep. It's like the core strength. And then you have the business department, and usually, and unfortunately, you would have these departments as opponents, yes. And you would have the risk with the idea of controlling, and the business with the idea that they need to, let's say, fight with risk to obtain something. And this idea has been very much destructive for the banks, and it's actually pushing down the agility, because it consumes a lot of internal energy on something that is of no value to the end customer. So therefore, no value to our business. So it wastes time, simply put. But once you start to build up this kind of partnerships with risk department, then you gain that agility, and the partnership will start something similar with finance as well. We'll start from the fact that you need to gain trust, and you need to be transparent, and you need to build knowledge on a consistent basis on both sides of the thing. So on one side, build risk knowledge within the business as well. And on the other side, let risk understand as well what are the business implications of whatever risk decisions that we take. Because we have a concept in Lean Six Sigma, which I'm a bit of a nerd about. I love Lean Six Sigma for the exactity of things. And that concept is the cost of control something, the cost of perfection, let's say, yes. And when you want things to be perfect, you can implement all sorts of measures as risk department. But once you start to understand where a business is coming from, you start to understand that the probability of something happening is one thing. Let's say the amount of risk associated to that is another thing, and the cost of controlling to prevent it from happening is a different thing. So what we have done, let's say, in my experience, and it was extremely good collaboration with risk, was trying to understand on both sides where we come from, start for the discussion as a partnership, and try to build products from there, and then build an agile team around it. And yeah, John. Yes, I see that.
No. Sorry, just a couple of things that were jumping to my mind there, because that's excuse me, a nice logical progression. And I remember that I think that the challenge of synchronization exists with agile teams in every organization, because they are by definition agile compared with the normal structures. It used to be the case that banking had three core competencies. The first one was customer service, the second was transactional ability, and the third was risk assessment. And in each of those three areas, banks they competed on those three areas as their core competencies. If we change one word in that, so customer service remains a core competency requirement for banks, and many banks, of course, are challenged, as are many other organizations on this, but it remains a core competency. If instead of transactional ability we say transactional agility, then the bank may be able to think in slightly different ways. However, risk assessment remains a core competency, and because of the regulatory framework, that methodological approach to risk assessment is always at the basis of the bank's thinking. And you mentioned towards the last of what you were saying about the cost of control. One of the things I think most banks have not yet actually recognized is the cost of control to the point of perfection is absolutely enormous, because once we get beyond, the usual 70-80% of perfection, diminishing returns kick in very quickly. So banks actually, as they get closer to perfect cost of control, start to become less efficient and less effective, and actually to be less competitive as a result. And for me, that's a classic reason why the adoption of agility, or the understanding and then the adoption of agility by a bank, actually makes it more competitive than other banks. So I think if we think about bringing risk as a partner into the Agile project teams, particularly around transactional agility, because transactions are very often where risk is challenged and where risk creates a problem. I think that could make a very big difference to the way that Agile projects are deployed within banks. Crucially, of course, that needs to be done right at the start, at the planning process. Indeed, even the pre-project phase of an Agile project, to get risk involved.
Yes, I fully agree. And actually, there is even one step before this, because as with any other company, you need to decide what will be the driver of the business going further. What would be the point in which, what will be the products in which, or services that will make you most successful in the future? Because the way that you build risk departments around agile teams, it differs quite a lot from the client segment that you're operating. And it's exactly like, as you said before, because there's one thing to try to build an agile team or build agility in a corporate client segment, in which approach is very much dedicated for each client. And there are also reasons for that, because clients are extremely large and extremely valuable, and there you can only have like bits and pieces of elements from agility, at the most maybe a Kanban approach. And the more you go towards the SME segment, or to the retail segment, where issue of scalability starts to kick in, the more you'll have the opportunity to streamline your products and to define what is customer value, and to have that approach from an end-to-end in your organization. And once you define, and this is actually where most of the banks I find in the European, at least, perimeter, this is where most of the banks are looking at, the SME segment and the retail segment, the one that poses more issues with scalability, the one that is mostly exposed to economic volatility, and where you really need to have agility as a bank to service your customer as best as you can. Those are the segments in which you start to have this discussion, replace risk. And what I have seen a lot of models actually happening around, and it's banks are experimenting with this concept. And what I've seen also, like a base camp model that will try to have a base camp risk team, like a core risk functionality, because you need that to ensure that you have a central approach to whatever risk policy you have as a bank. And then you have this kind of mission teams, this kind of risk people that are lent to various agile teams, and that they are put in various agile structures as they seem fit, so that for each project or for each release or for each product, they are building together with risk, with a business team alongside them. So you have a lot of variety in between. And it's actually a balancing act at the end, because I
was just going to say the one of the things that comes out of that for me is yes, absolutely, the SME banking segment is increasingly popular with banks, because I'm sure many banks realize if they get that segment right, the size of the market, notwithstanding the current challenges for SMEs, the size of that market is enormous. However, it is a market in which, because there are so many SMEs and each of them is different in its own way, their demands are not generic in the ways that some corporate demands might be for treasury, for example, or for international finance. The requirement is for the bank to be able to be specific at scale. And it's not scale in volume of finance, it's scale in numbers of clients. And that absolutely demands agility. And there's no way for the bank, I think, to avoid that. One of the things that might help you, I very much like this idea of mission teams who can be not parachuted into, but who can engage with agile project teams. I did, many years ago, I did some research around SME attitudes to risk. And one of the things that really might help would be for banks themselves, and particularly the risk team within a bank, to actually familiarize themselves with the attitudes of SMEs to risk, because, and this might be subject for a future Agile Monday chat, SME attitudes to risk are actually counterintuitive, and they change dependent upon whether that SME is growth focused or lifestyle focused. And that's a big challenge for banks to cope with as well. So I think this idea of a built-in agility in the risk team by having teams, mission teams, which can engage with agile projects is the first and probably most important step, both in practical terms and in terms of the mindset of the bank, in beginning to achieve agility within the risk structure, which I think is a great idea.
Mm-hmm. I have also seen. Yes, sorry.
Yeah, actually, I wondered if I can add here. Just remember that actually, yes, I think this is actually no doubt that having risks inside the team and the finances we discussed actually during the last 2 episodes. This will be really more efficient in terms of product development and time to market of the product. Because I just remembered actually that when I was working in Raiffeisen Group, it was like 13 years ago, and we had a so-called product approval process. So I was working in the SME product team, and actually we had involved risks and finances into the product development team, and actually this was very effective and like most efficient than a business team is developing the product by themselves, and then you go rounds of approval process, signing the product paper, etc. So really, it was faster when we had people from risks involved at the development stage, and namely people from credit analysis and people responsible for the credit policy. So we were setting, the targets of the product, the triggers for the product, etc. And then also we had a finance team included, and the financial model of the product was included. And then, like when everybody was involved into the development from the very beginning, it was then really easy and quicker to sign and approve this product and really deploy it for the customers. So I think we actually need, I think we will have a next episode, to discuss what exactly, the tools and techniques to do this.
I really like the example that you gave, Olena, because this is actually what is happening. And this is why I said, it's nice to be closer to the business, but how many product approval papers do you have a year? How many products and services do you launch every quarter? You don't launch every quarter. So basically what will happen, it's good to be inside an agile team when you develop these things, but having a risk person fully detached to an agile structure might not be so relevant, because it might not be a full-time job. And then you have those frictions between business and risk, and you'll have the risk person being demotivated, that is outside, that is a feeling that is not contributing on a regular basis. And there is one more thing I would like to add, and I know that John is also eager to Olena just said. that thing with documentation, the product approval paper, that is something that is core to the agile mindset, because we have the documentation, but we have something working. One of the values of agile is something that is working, a working software or system, if you want, over comprehensive documentation. So the only difference between that structure that you mentioned, in which you develop the product approval paper together and then you implement, in an agile structure, the only difference is that you also build it at the same time. So as you develop documentation, you build, and you do not make the documentation for all possible scenarios. You build the documentation as you build your product, as you go. This is how you gain agility, because you might encounter changes to the product that might lead to changes in documentation. But if you build them as you go, and also if you mitigate risks as you go in the project, then this is how you gain agility. What do you think, John?
Yeah, I agree entirely. And the sort of the minimum viable everything principle in a way, really. And excuse me, being absolutely certain to have risk involved and assessing risk at every stage of the project is vital. I just wanted to pick up on the mention of time to market, because clearly in a sector as competitive as banking, and as competitive as SME banking in particular, time to market is vital. It's a vital element of competitiveness. However, it isn't in the end the most important challenge for the bank. Time to profit is actually really, really important. And this is where risk absolutely needs to be involved, because time to profit, partly, of course, that's a compliance or regulatory issue, because if you're making money and you're not supposed to, then risk will be unhappy. So risk needs to be involved from its normal, if we say, compliance and regulatory aspects. However, there is also, in terms of time to profit for a bank, in an SME segment, there is also market risk, because SMEs are highly labor intensive. They take a much more time and effort to get a return, which is probably not going to be comparable in any individual sense with a corporate. So there is a huge amount of effort and commitment by a bank to service an SME audience. So SME attitudes to risk and how they may change will be a crucial element of the market risk that a bank faces. And I think the sooner that risk teams can be informed and appraised about that element of market risk, in other words, the ebb and flow of SME attitudes to risk, the sooner that risk can really get to grips with that, the more value they can add from the bank's perspective in assessing market risk, and also the more likely they are to understand the requirement for agility and to contribute effectively to the agile project teams. I think risk is, alongside the finance team and the HR team, risk is absolutely crucial to agile projects in the bank.
I really liked what you said about this perspective of the way SMEs are managing their risk and their attitude towards risk, because you see quite a lot of people in the corporate world that they are assessing the risk, but most likely they will not build a business because they see too many risks. And this is the beauty of the segment as well, because otherwise we will not have all these nice high flyers in the world, because they all started somewhere small and there were lots of risk. Either you didn't see them or your attitude is totally different. And once you have a risk department that is dedicated for a segment, and that understands what are the drivers of the segment and what is the dynamics of the relationship between that segment and the bank, then you have a more relevant positioning indeed, because as opposed to other client segments, SMEs, the way they see banks banks, they see them less as a partner, unfortunately, because of their lower negotiating power that they have. And because of this kind of, scalability approach that the banks is trying to push on them. So if you as a bank, you manage not to bother your customer too much, and you manage to read what they might need, and you manage to be there for your customer in the most simplistic way, in the most obvious way for them. If you manage to do an SME to reduce his relationship with you into 5 minutes a week, that would be the bank of your choice. Actually, the way banks are gaining and are competitive in this segment is by the amount of time that they bother their customer. So and this is something that we need to make a switch, because my initial background was as a corporate banker, and I was used on clients treating banks as partners, and I felt I derived a lot of importance from working in a bank because of that. But once I started to work in the SME world, SME environment, I did not realize that actually the companies are switching, that they're looking at the banks. And I have to tell you, my management experience in that segment, I almost did some mistakes, let's say, because the initial way of approaching was corporate, which is rigid for SMEs. So once you start to understand their mechanism, it's then you start to play for them.
Yeah, absolutely. And I think, I've worked in a bank, and I've owned and run several SMEs, and I see the understanding gap as enormous. And that's probably a good point for us to be looking forward to next week's session, I think, where we'll talk about some of the tools that we might use for Agile in risk. Is that right, Elena?
Yes. Let's talk about concrete tools and techniques, how actually get risks involved into the business and into the product development, etc. Because actually that makes also them understand. So I'm always going for the cooperation, and this is very precious if you have in the bank really risks teams with whom you can cooperate and with whom you cooperate really good, because this is very crucial. Because in that case, they're not thinking in the way that the best loan is not not the delivered, not the granted one, but really if we do not grant, if we took a loan product, let's say, and we see, and when everybody from all the development team, including the risks team, will see the financial model of the product from the very start, and they will really understand that if we do not grant loans, for example, then we do not earn some margin on some stuff. This is not the case, not to grant, but this is the case, to think the product the way that the customers will be satisfied with the product, but also all the risks will be mitigated somehow.
Yeah,
so some treats. This is the case in all this. And actually, if we turn to SMEs, I think now what I see now that they actually SMEs starting to expect from the banks to be the partners. So not to like the way that they not want or willing to ask a bank to do something for them, but they start to expect to have it automatically, because they're starting to have a using experience as the private individuals when all these digital tools and innovations are implemented faster, and all these analytical tools, let's say financial analytical tools, etc., are available already for them as a private individuals, let's say. And when it's not available for them as a business customers, they do not understand it. They are starting to expect that they will have all these additional services, as a default.
Yeah, and I think that would be excellent for us to talk about next week. I think we've passed the end of our 30 minutes here, actually. So I think there's so much to talk about. We could do 5 weeks on this, I think, probably.
Exactly. So probably let us summarize shortly this episode, and we will continue next Monday on the topic. Maria, would you?
Sure. So the way we see it and the discussions that we have around it is like, regardless of the business, but mostly in the banks, managing risk in a project is becoming critical. And the way you manage it, or the more you manage it, is actually contributing to your business agility. The way you manage to integrate risk in a risk department in your team or not, the way you are responding to the economic volatility that is happening around you, and the way you are responding to the requests of the customer who start to have higher and higher expectations from you as a bank, is a way that you're managing all sorts of types of risk in your agile projects. So what I would propose for you next time is to look not only to the risk department as a structure in a bank and how do they interact with agile business teams, but also to take on a different approach in banks, and not only to look at risk an anti-value, the risk itself, and how does a project team, a business team, or whatever team that needs to deliver something, how is managing this value and whose responsibility it is at the end.
Yeah, and I think my simple summary would be get risk involved and get risk to encourage everybody to think risk.
Yeah, thank you very much. Yes, indeed, of course. So I'm looking forward to the next Monday already to discuss these details. So thank you, John and Maria, for today, and see you next Monday. Thank you, everyone, for joining. Goodbye.
Thank you, Maria and Elena.
Goodbye.
Bye. Bye.